All right, so we're going to talk about today a couple different strategies, but we're going to be introducing the next class. We're going to be doing short-term flies and calendars and volatile markets. We'll talk more about that. And let's dig in. Today is for educational purposes. Here's a snapshot of the new class that we'll be doing. It's going to be a part 1 and a part 2. We're going to prepare for battle, and then we're going to go to battle. So if you look at this, trading flies and calendars in volatile markets, part 1 is going to be this Saturday, right? So this would be part 1. This coming Saturday, we'll be laying the foundation. Saturday, April 18th, we'll be meeting at 11 Eastern, 10 Central, and there'll be 2 hours at least of teaching. And what I'm going to do is we're going to lay the groundwork. We're going to fly a plane, for 4 weeks together, but probably be nice if we teach you how to fly the plane, some of the mechanics, what are the buttons, all these kind of things. So what I'm going to spend most of the time is going over what flies are we going to be doing, talking about the butterflies and calendars in volatile markets. And again, what I like about this opportunity for finally dipping back in short-term strategies is a market seems to have found some kind of range here, but we still have nice premium in it. And I think it should be really good for this type of trading. And so that'll be this Saturday. And so that's building the foundation, teaching you what are the terms, what are the strategies, what are they, how do we trade these strategies, getting you all the learning stuff. And then a few days later, Tuesday, April 21st, we're going to do 4 weeks of live trading, doing this together with the idea helping you get better at the craft, right? We can talk about this, and if we just did this, a lot of you might go do your own version of it or whatever. And here, we're going to trade it together for 4 weeks, Tuesdays and Thursdays. We'll be meeting at 1 Central, 2 Eastern. Everything will be, and basically what we're going to do is each class will be 30 to 40 minutes, and we'll be putting a live trade on. And kind of the bonus is the third strategy that we're going to be trading during that Tuesdays and Thursdays for 4 weeks will be the kind of the successful call ratio back spread strategy that we've been doing in the Sheridan community. Mark Fenton, who works with me, has kind of spearheaded this one in terms of a lot of the logistics. He's done a great job on it. And so we'll be doing the ratio back spread. I'm sure Mark will be on with me most days. We'll do this together some of the times. But that's it. And so the idea is build the foundation on these 3 strategies, the fly, the calendar, and the back spread short term. And again, what does short term mean to us? Short term is going to be between 7 and 15 days, 7 and 17 days to expiration. So most of these trades we'll put on, we're going to be out in probably 3 days, right? Most of them. So we're not going to hold them to expiration or anything like that. And so what's nice is the inventory. Every week we're going to put on 3 more. There'll be no inventory. Every week, 3 more. Every week, 3 more. The back spread, the short-term flying calendar, all short-term. Which types of butterflies will we be discussing? We're going to be discussing whatever works best for this environment. Between balanced butterflies and broken wing butterflies, I'll do whatever gives me the best Greeks starting out with. And right now, what's lining up when you normally get a high volatility environment, balanced butterflies are going to have better Greeks than in terms of starting closer to delta neutral than broken wing. So to me, whatever has better Greeks, I'll be doing. So during the class, I might do some broken wings, some balance, but you need to know when to do the different ones. So because I think they're contingent on each other, I think you need the schooling before you get in the airplane and fly it, especially in this environment. And so If you just do the Saturday one, it's 147. If you do the 4 weeks, twice a week, that'd be 397. But what we did is just to make it better for everybody, for both of them, it's 435, which is a 20% discount. So you're really just paying $38 for this one is what you're doing. You're getting 20% discount. So I think that's going to be a very practical class. Every class I'm going to put on the Trade Live. We're going to do this together. So what'll kind of work is maybe Tuesday I put a calendar, Thursday butterfly, and then one of those 2 days I'll put the back spread on. And each week we start again. Those 3 will be off. We'll do it again. So during the class, we'll probably do 12 trades. Gary says, will you be giving entry and exit points in the trading class? Better than that, Gary, we'll be doing it together. So you're going to know the entry and exit better than I do. So I'm doing the trade with you, right? So you're going to see me do the trade. And what's nice is we're going to be doing these trades together. So you'll see the entry, the exit. And with me, I'm giving you the risk management. So I'm not making anything magical. I'm telling you exactly what I'm doing, why I'm doing it, when I'm going to take it off, if I'm going to adjust. And we try to keep it simple. With these short-term trades, I don't do a lot of adjustments. I'll be honest with you. Why? I'm only going to be in them a couple days, right? Put them on, take them off. Kind of the wax on, wax off philosophy of the great, who was the Karate Kid in the movie Karate Kid? Who was the Karate Kid sensei? What was his name? Was it Sensei? No, what was his name? I know in Kung Fu with David Carradine, it was Master Po. Who was it in Karate Kid? None of you guys are Karate Kids? All right. Whoever the guy's name was. Mr. Miyagi. That's right. That's right, Mr. Miyagi. Sweep the leg. That's right, Mr. Miyagi. All right. So that's the class. I'm excited about it. Excited to get back into short-term trades. But again, what's nice is you got the juicy premium. So you're getting your break-evens. You're getting very wide break-evens. And again, so the live trading part will take place a week from Tuesday, but this Saturday will be laying the foundation. Now, hey, Dan, what if I'm working? If you're working on that Tuesday or Thursday, what I'll do is, as soon as I'm done with the class, so let's say the class goes 35 minutes or whatever, I'll send an email out, which will go out, which will say what basically give the trade and stuff like that. But again, the idea here, I'm taking a novel approach here, folks. This is a novel idea. I'm trying to teach you to fly the airplane, right? I could give you the trade. What do they say? Teach a man to fish, then he can fish, or whatever that is. But the idea here with Sheridan Mentoring, we've been around a long time, and our whole philosophy is teach you to do this yourself, right? And that's the goal. So in these things, I will put the trades on. There will not be a doubt what the heck I'm doing, right? And you can ask me any question while we're doing in the class. As you watch it recorded, you could ask questions. Again, everything will be recorded. If you're working, you can ask when you watch it, when you get home from work, you can, there'll be a spot there, ask Dan a question. And again, an email will be sent to you right after the class is over. Again, just letting you know what the trade was, why we did it, that type of thing. Directional stuff, directional butterfly. No, again, Trevor had a question. What about directional butterflies? Folks, do you think if I taught you 17 strategies, you'd get good at it? If we taught 17 strategies in 4 weeks, do you think you'd get good at it? Yes or no? No. So, jack of all trades, master of none. We're just taking a couple trades, basically, the fly and the calendar. And we're going to teach you how to do them the right way. And we just threw in the back spread just because the market's still, we're still having 2% moves every day, or 1 to 2. And so I think that's a good trade to go in. As far as directional butterflies or direct, again, we're starting to get different deviations of these strategies. I'm not getting into everything. No, I'll answer any questions you have on it, right? If you have questions on something, but I'm not going to, the idea is to help you become a craftsman, right? What good is it? You learn a lot of stuff and you can't apply it. So the goal is build a foundation this Saturday, and then we're going to work 4 weeks together on live trades, and every trade will be put on live, and we'll go from there. Rick says, what about broken wing flies for earnings? Yeah, they're good. And I may look at some, and we'll look at some stocks. I mean, most of what I'm looking at will be SPX, some SPY, because you have a diversified vehicle of 500 stocks. I mean, you don't have to deal with earnings, right? And again, maybe I'll do a class on earnings, but again, here's the thing. I would love to do 50 classes in one and teach everything, but that's hard, right? And I think what Rick's talking about, that's a good strategy. Broken wing butterflies for earnings, and maybe we'll do an earnings class this time. I don't know, but I think this is, what I'm trying to share with you is stuff that we've done for a long time, and try to get you good doing just a few things. Keep it simple. And again, these are short-term trades. Remember, weeklies. What are weeklies? Weeklies can be 40 days out from expiration. They can be 7 days out. So we're talking short-term trades. This can involve weeklies and monthlies. It doesn't matter, but it's just trades that expire in 7 to 17 days. And, risk management will be the essence. We'll talk about hedging. We'll talk about everything with these. But again, trying to focus on 2 trades, and we're throwing in a third bonus one, but we want it simple. Tuesday in class, we'll do 1 trade. Thursday, we'll do the other. And I'll pick one of those 2 to put a back spread on. Just want to keep it simple so you can do it. We don't have real complicated rules. You put it on, you take it off, and that'll be enough for a lot of you to work on over the next 4 weeks. So just give you a little flavor, as they say, of the types of strategies that we'll be doing. Here's, again, I did these slides, I don't know, maybe an hour and a half ago. So SPX is about 6 points higher than where the screen says, but it gives you the idea, right? And again, we've made a tremendous recovery here, right? In the market. This is SPX 2835 up 74 points. We're actually up about 81 points right now. And VIX is finally under 40, isn't it? How many thought they'd see VIX come under 40 in their lifetime? Yeah. As you're getting a rally today with NASDAQ, a lot of these tech stocks, and Apple's up $14, which it's just pretty amazing, a lot of this stuff. But anyways, so market's up. So here's the first strategy that we'll be looking at. Here's a calendar. How many people have done live calendars? How many people have done live calendars? Live calendars. Okay, and so what we're going to do is try to help you to get very mechanical. We'll either put the calendars on Tuesday or Thursday. We're going to keep it mechanical. The goal is when we're done with the 4 weeks, you'll continue, right? That's the goal. We're trying to build these habits. So here's an example of one. Buying 1 May 8, 28.35 call, sell 1 May 1, 28.35 call. This is going for around a $12.50 debit. Again, if you'd like to go cheaper dollar-wise, you can use SPY. So the question says, are these day trades? Is that what you mean by live? No, what I mean by live is live, right? Live means I put the trade on. If we meet live, I put the trade on in front of you. We're putting it on together. That's what live means, right? Day trade, what is a day trade? A day trade is a trade you get out of in a day, right? These aren't day trades, right? So day trade, I buy Apple in the morning, sell it in the afternoon. These are not day trades, right? Live means I do it live in front of you, right? Right, so you can see what I'm doing. We put the class on together. Is that clear? Yeah, this is 17 days out. So yeah, I'll be going probably from about 7 to 17 days. This is short term, right? To me. Normally I would go up to 15 days, but if it's 17 days and the expiration is a Friday, I'll usually do it. But so here's an example. Again, what is a calendar? Calendar is simply an income trade. You're buying a further out expiration, you're selling a closer in expiration, and you're doing it the same strike. You could call it a horizontal trade. And this is a single calendar trade. Will I be presenting double calendars? No. I think there's no need to. Single is fine. For short-term trades, I'm going to be out 2 and 3 days. I don't want to mess with double calendars, right? It's too much. It just complicates things. So no, I won't be messing with double calendars. Maybe as an adjustment, I might talk about it, but again, the goal is to keep it as simple as possible. So one of the nice things about a higher volatility environment is you get a little bit wider break evens on your strategies. If you look here, these are much wider break evens than maybe a couple months ago when VIX was 13 or 14. What do you mean by break evens, Dan? I'm talking about expiration break evens. This is a graph in Thinkorswim. Here's the graph at expiration in 17 days. And the purple line is the graph how it looks today, right? When you're trading options, do you think you're trading off the expiration graph or the graph today? What do you think is more relevant when you're a trader? What the graph looks like today or the graph at expiration? The graph at expiration, I call that Disney World. The graph today, the purple line, that's reality, right? So that's what I'm managing. Now, over time, over the next 17 days, this purple graph will merge into the green graph, right? And this is an income trade. All it means, income trade, is it's a positive theta trade, right? The one I'm selling is going to decay quicker than the one I'm buying. So I'm getting positive time decay, right? And that's saying if all things being equal, if the only thing that we advance is 1 day, I'm going to bring in $41 theoretically. What can offset my theta? What if I don't make $41 today and I lose $41? What could be a possible explanation? What if I don't get my theta? Who's to blame? Volatility. Yeah, volatility goes which way on a calendar? Volatility drop. Volatility drop. Volatility going up would be helpful, right? Because you're buying more extrinsic value in your long than you're selling in your short. So volatility goes up, you're pumping more extrinsic into your long versus your short. So again, what's nice is we'll put on 4 live calendars during the class each Tuesday or each Thursday. So you get practice at doing these the right way. We generally put these on close to delta neutral. Now here you notice the distance between the long and short is 7 days. Some days I'll have 7 days. Some days I'll have 1 week between the long and the short. Sometimes I'll have 2 weeks. Once in a while I'll have 3 weeks, and we'll explain that during class, how we determine how far to keep the long from the short. So again, what you're trying to do here is, if this is the expiration break evens, and here's the underlying right here, you're letting this percolate in here like a good cup of Folgers coffee. I don't know if any of you are old enough to remember Folgers coffee. My parents used to drink it. But the goal is I'm looking to be in these trades maybe 20% of the duration. So if this is 17 days, maybe 3.5 days, that's about it, right? And we're looking to make our profit and get out. So this would just be an example. Here's one in SPX, but we'll also look at calendars in some range-bound stocks, right? There's some stocks that little more range-bound than the indexes at times. Agree? So this is one of the trades I'll be doing. The other trade will be a butterfly. Really, the foundation of a butterfly is you're just selling at the money options. Here we're selling the 2840, two of them, because they have the most extrinsic value. And in this case, we're buying protection 50 points away, up and down in the calls. This is called a call balanced butterfly. What does that mean, balanced? The distance between the lower strike call and the short call is 50. The distance between the short call and the upper strike call is 50. That'd be called a balanced butterfly. That's going to have equal risk on the upside and downside. A broken wing butterfly would be if the distance from the short to one of your long strikes is different. So let's say this one was from the short strike to the upper strike call was, instead of being 50, if it was 40, and if this was 50, then we'd call it unbalanced or broken wing. But again, the goal is to keep our position deltas for these short-term trades generally between one positive and one negative, because the whole key here is letting theta, positive decay, work for you. That's the goal here. And so here's an example in SPX, 17 days from expiration using May 1. We buy one May 2790 call. We sell two 2840 calls at the money and buy one 2890. The cost of this is $4.85. So your margin or risk at your brokerage firm would be $485 for one, right? If you did 10, it'd be $4,850, $4,850. And they trade pretty liquid. So we'll give you all the guidelines and rules for trading these, getting in and out if we need to make any adjustments. But again, the goal, short-term trades, we try to keep it as simple as possible. Put it on, take it off. You're going to do one per week. I mean, the advantages of short-term trades are you're going to turn over your inventory a lot more, so you can make more money, right? And putting up less capital. The negative of short-term trades is you have more price risk. Agree? One of the nice things about short-term trades, they're not as volatility sensitive as 40-day, 50-day trades. But the main thing you deal with is price risk. And so one of the things we try to do is we get out of the trades relatively quickly. We have good, strict risk management. But you want to recognize the pluses and minuses of these type of trades. And all right, and that's the butterfly. And then here's an example of the ratio back spread that we'll be doing in class. We have normally done it in SPX, but I'm just showing you an example here in SPY. I'm going to show you an example in SPY because you can do these strategies in SPY, would be cheaper. But here's an example, and I'm just using, just so you know what I'm talking about with the ratio back spread. So here's an example in SPY. We were at 282.52, and I went, this would be an out of the money call back spread. I sold two April 27, 291 calls, right? So at the stock at SPY 282, right? I sold on the graph here, it'd be about, I sold the 291s, and I bought the 296s. So it's an out of the money call back spread. I buy three 296 calls, sell two 291 calls. Really what it is two call credit spreads and an extra call, right? Two wide call credit spreads and an extra call. And we'll show you how to do it in SPX. And here's in SPY. So what's nice is you get a credit for the downside, and you can see the graph on the upside. You can do real well there, and we'll teach you how to deal with the risk, some of the risks in the trades. But this is a nice speculative strategy that has worked out real well. And as long as we keep up 1.5 to 2.5% moves in the market, these are very good strategies. Questions is why did I use April 27 instead of April 24th? No particular. I mean, I generally like with this type of strategy, it doesn't really matter as long as you're in a liquid vehicle like SPY. Normally I like a Friday expiration, but a Monday or Wednesday is fine. This is a Monday expiration, so it doesn't really matter with these strategies. I mean, I'd like to be maybe 7 to 14 days out on these strategies generally, but no particular reason. I just wanted to be out. I think this was April 27, so this was 13 days out. All right, folks. Well, I'm excited about that. This Saturday, again, we'll lay the groundwork this Saturday, and then Tuesday starts the journey, 4 weeks. We'll help you develop into a good craftsman. And again, even if you're a beginner, I think this would be good because we're kind of holding your hand. We're doing the trades. Now, if you're a total beginner and you've never traded before, I would recommend the first week or two do paper trade and then maybe one live contract the last 2 weeks, just so you make sure you know what you're doing, right? So we're going to walk you through this. And the thing is, you'll get practice. So every calendar, we'll do at least 4 calendars. We'll do at least 4 butterflies, and we'll do 4 back spreads. And so again, practice doesn't make perfect. Correct practice makes better. And I think this is an opportunity for you to see strategies that we've done for a long time, and we've got them down pat, at least things that make sense to many people who've been doing it. And I think it could be a big benefit to you. How do you compute profit on the back spread? What you base it on, like anything else, you compute profit on a calendar, or you compute profit on a butterfly or a credit spread or a back spread the same way. You look at your risk or your buying power. If it costs you $1,000 and you're trying to make 10%, it's always, the way we look at it, is 10% of your margin. If you're not always profit, but if your profit goal is, let's say 10%, 10% of what? 10% of your margin or your risk of the trade. Yes, this will be recorded and you'll be able to watch this. We'll be sending a link out. So if you have any questions, you can email me, dan@sheridanmentoring.com. If not, we'll see you this Saturday at 11 Eastern, 10 Central. Be some information here. You can sign up for, just go to Sheridan Mentoring, front page, and you can sign up. And we look forward to seeing you. And thanks, everybody. I appreciate it. And have a good day. Thanks.